This is the FlipNerd.com Expert Real Estate Investing Show, the show for real estate investors, whether you're a veteran or brand new. I'm your host, Mike Hambright, and each week I bring you a new expert guest that will share their knowledge and lessons with you. If you're excited about real estate investing, believe in personal responsibility, and taking control of your life and financial destiny, you're in the right place. This is episode number 425, and my guest today is Steve Bighaus. Steve is an expert at using government-backed loans like Fannie and Freddie for financing single-family rental properties for investors like you and me. I've actually known Steve for several years, and with over 30 years of experience, his knowledge is really invaluable. Today we talk about financing your first 10 rental properties and the pros and cons of different types of financing that might be available to you. We also discuss the pros and cons of paying down debt quickly versus staying highly levered, and where Steve thinks we're at in this market cycle. If you understand the power of building wealth with rental properties, get a pen and paper ready for this episode. You're going to learn a lot. Please help me welcome Steve Bighaus to the show. Hey, Steve, welcome to the show.
Thank you, Mike.
Yeah, I'm glad to have you back on.
That's always a pleasure to be on your show.
Always good to see you.
Yep.
I'm excited to talk about this today because you and I, both near and dear to our hearts, is rental properties, building wealth with rental properties. And one of the biggest challenges that folks have to overcome always is the financing of those. And so you're definitely our resident expert at that, and excited to pick your brain and get some thoughts from you today.
Well, thank you. Yeah, it's always been kind of a passion for me to help people out, buying their investment properties. I mean, let's face it, there's a comfort level, when people are buying their primaries and second home, the investment property is the one that's going to really make their money. So it's something that's going to shape their future.
No doubt, no doubt. And it's easy to look back and have hindsight, right? I mean, I have a decent size rental portfolio, but I look back and say, man, why didn't I 5 or 10x that? Because I could have. I just, fixed and flipped and wholesaled and didn't keep as many as I would like. But I could have, in hindsight, I wish I had kept hundreds, knowing what I know now over the past 10 years.
Yeah, I can appreciate that. I mean, I think we all look back and look at things that we could have always done better.
Yeah.
Maybe done differently.
The interesting thing, and you've been doing this for a long time, and maybe I'm going to ask you to tell us a little bit more about yourself and introduce you to those that don't know you yet in a second. But maybe you could give some quick thoughts on those market cycles, right? The lessons that I've learned over the past 10 or 11 years here now, we're going through kind of 1.5 or 2 market cycles, right? And so is what I'm saying right now pretty typical of market cycles? And people say that at the top of every market cycle, like, I wish I had done more.
Oh, of course they do. Yeah. I mean, everybody's always looking at that, and of course, a lot of people, when they look to the future, and as far as the mortgage industry, says to look at the past, because the past is going to tell you what the industry is going to do. It always runs in waves.
Yeah.
Right now we've watched interest rates climb, house prices have gone up, and basically, interest rates will stay that way for a while. Then there'll be another reason to lower the interest rates again, and we'll start another refinance boom. So right now, what we're seeing in the industry is we're seeing companies lay people off. There's going to be we're going to watch companies close their doors because they base their business around refis.
Oh, lenders you're talking about.
Yeah, and so you're going to see that. I mean, there was a local bank up here that laid 150 people off, in their mortgage department, and you're going to see more of that. I mean, it's just the way it is.
Right. Well, Steve, before we jump into this anymore, why don't you tell us more about your background and who you are for those that don't know who you are?
Okay. Steve Bighaus, Sierra Pacific Mortgage. I've been in the business. Actually, this is my 30th year in the business. And so
wow.
Done. Spent the first half of my career in banking. I was working for a local bank here in Seattle as a vice president, running their real estate department. Started working with a group of investors back in the early 2000s, and so they were buying stuff here local at the auctions, and it was a good. I like doing it. I like going to the auctions, seeing the things that were going on. Unfortunately back then, we all know, and that the products that were just a smorgasbord of products. Anybody could buy investment properties. The Fannie and Freddie's guidelines were about as loose as gooses on cash out. So you saw a lot of people that made a lot of money. But those same people that made a lot lost everything.
Yeah.
And so it's been interesting to watch the industry. It changes. It'll be interesting to see how some of the the easing of some of the Dodd-Frank rules, how that's going to affect the industry.
Absolutely.
And so I think it's going to help. It's going to help the community bank world a lot, and which is going to be good. The mortgage side. I mean, let's face it. Anytime you get the government involved in our business, they have a tendency to go a little bit overboard on disclosures and timing and different things. And so, it's just, you got to roll with the punches. I mean, I hear a lot of people complain about it, but it's just part of the industry. And you're going to stay in the industry, you got to do it because we're not in a position to drive the bus.
Yep, absolutely. And so, Steve, maybe let's talk a little bit about your specialty, because for a lot of folks that are listening right now, they're very familiar with hard money lenders and local community banks. And your specialty is really using Fannie Mae and Fannie and Freddie money, government-backed money, for rental properties. In fact, you finance. I mean, maybe you could give us some perspective over the type of volume that you do in a typical year, the number of loans that you help investors like me or people that have less than 10 financed rental properties actually use government financing, which the benefit of is that it's generally subsidized by the government. So the rates are pretty good and you can lock them in for as much as 30 years. But maybe talk a little bit about that and give some perspective just for listeners as the type of volume that you do.
So myself and my team, we probably average 400 plus loans a year for real estate investors. So we stay pretty active as far as what we do. Currently right now I'm in 16 different markets. Okay. And that's typically I build my business where the investors are going. Some places investors just don't go for a variety of different reasons.
Right.
I'm still, the thrust of my business is with the conventional financing, so with the government-backed money. I would say probably 99.9% of my stuff sell to Fannie, because I just feel that Fannie's a little bit better with the investors. So Freddie Mac still got it capped at 6, and their utilization of rental income is just slightly different. Fannie's a little bit better, and so it's a better vehicle for me.
Okay. And let's talk a little bit about using Fannie funds for real estate investors, because a lot of people may not realize that they're using community banks, or they're into hard money and they stay in the hard money even if it's a rental for a while before they start to feel the pain of those big interest payments. But just maybe share a little bit about actually using Fannie money for people that don't really know that's even an option for rental properties.
Well, it is, and like I say, the rules with Fannie Mae are 10 financed properties per borrower. So there's ways to capitalize on that. So like if you're a husband and wife, domestic partners or whatever, where you can capitalize on it. So that's always a good vehicle to utilize. And it's probably the cheapest money you're going to get.
No doubt.
If people are using, and it's long-term, so you can do it, 30-year, 20-year, 15. Whereas, if you're going to work for if you're going to go to like a local community bank, they'll probably do the amortization on maybe a 20, 25, or 30, but they're typically going to have like a balloon on it or a call, because that can allow them to go back and reprice.
Rates adjust every 3 to 5 years or something.
Yeah, so there's always that interest rate risk exposure.
Sure.
When you have something like that. So the government money is a good way to go. Sometimes people, they don't want to, they get upset because of the documentation. And I just tell them, I said, it is what it is. You want to get the money, you got to play the game. And of course, when you're working on the smaller loans, people automatically think, well, if it's a $50,000 loan, it's got to be really easy. It's got to be just as, it can't be as complicated as a $500, but it is.
If you're an active real estate investor already doing deals and looking to double or triple your business, you should consider joining the Investor Fuel Real Estate Investor Mastermind. We're a small group of investors that share our best practices, tips, and tricks with one another in an effort to all win. We limit our membership to only 1 to 2 members per market, so everyone shares their knowledge, tips, and tricks openly and honestly. Our members include some buying 1 to 2 houses a month, up to some of the most respected investors and leaders in the real estate investing industry, some of which have personally done over 1,000 deals. If you'd like to be considered for our invitation-only world-class mastermind, please visit investorfuel.com to request your personal invitation. Our next meeting is coming up quickly. Go to investorfuel.com now to learn more.
Whereas, if you're going to work for if you're going to go to like a local community bank, they'll probably do the amortization on maybe a 20, 25, or 30, but they're typically going to have like a balloon on it or a call, because
Right.
that can allow them to go back and reprice.
Rates adjust every 3 to 5 years or something.
Yeah.
Like that.
So there's always that interest rate risk exposure,
Sure.
when you have something like that. So the government money is a good way to go. Sometimes people, they don't want to, they get upset because of the documentation. And I just tell them, I said, it is what it is. You want to get the money, you got to play the game. And of course, when you're working on the smaller loans, people automatically think, well, if it's a $50,000 loan, it's got to be really easy. It's got to be just as, it can't be as complicated as a 500, but it is.
Yeah.
So there is no difference.
One of the things that I coach and mentor a lot of folks and have for many years. And one of the things that I tell them when they're getting started, if they still have their corporate job, if they're part of their goal is to accumulate rentals, then I say, hey, because I know one of the challenges is if you do like I do and you quit your job and kind of cold turkey, you just go into the real estate investing business, kind of burn your boats. There's some benefits to that for your business, is that you burned the boats, like there's no turning back.
Right.
But from a financing standpoint, then the problem was, everybody wants 2 years tax returns if you're self-employed.
Right.
They want to see that history. And so we kind of advise people, I've advised people that are coaching, that are students of ours, to say, look, or maybe it's their spouse, like don't both quit your jobs. Like you need to show that history so that you can finance it. And then that's what Fannie and Freddie are going to require, right?
Yeah. But there's some, some other alternatives if somebody does that. I mean, at least, for a short period of time, where they can utilize non-conforming sources for funding. And, rates are going to be higher.
Right.
And that, but it's not going to slow them down as far as buying properties.
Right. Right. Steve, maybe you can share some thoughts on one of the things that we were talking about before we started is using leverage, right? So I think one of the benefits of using Fannie and Freddie, government money, is that they generally are locking in your rates for 30 years, right? Mm-hmm. And like you said, nobody else does that. Or that I'm aware of. Not many, right? I'm not aware of anybody else. But it was interesting as a lender to hear you advocate for paying down debt. So a lot of times lenders, you benefit from refinancing loans and kind of keeping the loans going, but you're more of an advocate of paying off debt. And we were discussing about how there's really kind of two lines of thought, which is some people are in the class of, I want to get my debt paid down on my rentals so that they're paid off and they're cash flowing better than ever at some point. And then there's people that use this phrase, kind of lever it forever. As long as you can get cheap financing, you can lock in a long-term rate. Why would you ever pay that off quickly, right? So let's talk about that a little bit.
Well, I tell people I'm a meats and potatoes guy. Nothing fancy about what I do, and being an ex-banker, I'm a little on the conservative side. So when I get people that are buying their investment properties, my thought is what you want to do is you want to try and accelerate that payoff.
Yeah.
The goal is to, a lot of times, 90% of the time, people want to do it. It's a retirement vehicle, and so by the time they get 55 or 60, maybe they can retire early, because they've got them paid off. So if you've got a goal like that, then it's doable. Whereas, and I understand leverage, because sometimes, you can have a property where you got a ton of equity in there. Maybe you can utilize that money to maybe buy another property or do something else with, maybe improve your property, just for whatever you do.
Sure.
I'm a fan for that, but to just arbitrarily say, refinance forever on every one of your properties, I'm not a big fan of that.
Yeah.
And, part of the reason is I utilize this example, guy's going to retire at 65 or 66, whenever he's going to retire. He has 10 properties. They all got mortgages on them. So instead of making $500-600 a month, he's making $100.
Yeah.
And because everything's leveraged. And then the other thing you got to be careful about when you're, with the refinances, the values run in waves. Right now we're in an up value. At some point in time, there's going to be a correction. Values are going to either, they're going to stabilize. It could possibly go back down again.
Absolutely.
And so you're a slave to appreciation, which I'm just not a big fan of, because, we saw how well that worked in the past with doing that type of thing. But I think if a person does it wisely and selectively, leveraging, it can be done. But at the same time, and I told you this earlier, people are buying properties in these markets they're paying as much for the house as what some people do for a car.
That's right.
And paid off 5 and 6, 7 years. You should look at the same thing.
Yeah, and you tend to focus on rental grade markets too, right? So there's lots of $60,000 to $100,000 type rental properties. So
right.
Yeah,
Yeah.
it is funny. It's interesting. I haven't done a lot of this, but you can actually, and this isn't Fannie and Freddie type stuff, but as a lender, you'll have some insights to this. You can, if you have a lot of equity in your rentals or in other properties that you own, you can still pledge that as collateral for additional lending sometimes, not necessarily in a government-backed thing, but you don't have to necessarily refinance them and pull the cash out. I know that with a couple of my lenders here, I can pledge that as collateral towards other lines.
Absolutely. Yeah. So there's a thing, whether the, cross collateralization.
Right.
You see that a lot of like in SBA financing. Well, SBA financing, man, they reach out and get everything. Yeah. But yeah, that's fairly common. Yeah. And then there's at a point in time in that, once that debt's paid off, they'll release it, or you can request to have it released. And so that's when a really good community bank comes into play. Yeah,
and I found that with the same thing with community banks, local banks, they're a little more flexible, right? When the bigger the bank, or if the government's involved, there's just getting to that decision maker is nearly impossible, right? Or somebody that can say, that makes logical sense, I'll take that into consideration. They're like, the government and big banks are like, if it's not on this form, it doesn't matter, pretty much.
Right, absolutely correct. And that's the beauty about a community bank, is they can kind of think outside the box a little bit, not in a bad way where they're going to get themselves in trouble, but they can see the bigger picture. Whereas with with the larger institutions and that, it's more of a, let's fill in the boxes. And,
no doubt. I have a community bank here that I've financed a lot of my rentals through over the years. And I walk in and the president sits to the left and the guy that I deal with sits to the right, and they know who I am. They shake my hand, and sometimes I'll tell them a situation that's going on or I have in the past, and they're like, "Oh, we can talk through that." Like because the decision makers are right there, right? Mm-hmm. Yeah,
and that's good having that type of relationship. I tell all my investors, I said, find a good community banker, have him in your back pocket, because at some point in time he's going to come in handy.
Yeah, maybe you could share some thoughts on that very topic right now. So I know in the last downturn, 06, 07. A lot of lenders got wiped out. A lot of lenders went away. A lot of people's financing went away, right? So I got started in 08, and the first thing that I started doing was calling banks, calling lenders, and a lot of them were like, "Well, why don't you try us back in a couple of years?" or "He doesn't work here anymore," or "No, we don't lend on real estate anymore." I think somebody once said that's evil. We don't do that anymore. And so I think the lesson learned for people that kind of went through that, and not so much me because I was just getting started in, but people that lost everything or had their loans called and were really put in a pickle, is that they had a really good relationship with a lender or maybe two. But the lesson they learned is, gosh, I need to have relationships with a whole bunch of lenders so that if this happens again, I probably have somebody inside of there that's going to have my back.
Yeah, I think that's probably a pretty good idea. I mean, I'll give you an extreme example. There was a guy here that I followed at the auctions back in the mid 2000s, and he was pretty aggressive. And he had, at one point in time, he had about 40 rentals around here, but he lived on credit. And so when the market went south, you know what he does? He puts all the keys in a box, gives it to his assistant, say, take them back to the bank. I'm going to Bali for 3 months with my wife, so make sure it's all cleaned up by the time I get back.
Wow.
And
that's crazy.
So that hurt that bank. I mean, getting 40 houses back, it was a fairly large savings bank here in the Northwest, and it crippled them for a period of time.
Wow. Well, where do you think we're at in the market cycle? I mean, you've been doing this for 30 years. So where do you think we are right now, and where are we going? And truthfully, if you can buy them right, is there ever a bad time? We know there's good times and times that are not as good to buy rental properties, but if your vision is long-term buy and hold, is there ever a bad time?
So, well, I mean, you got started out in a good time.
Yeah. Coincidentally, I just got lucky. I mean, it wasn't planned that way. It was just coincidental.
Yeah. I mean, a down market's always an opportunity. Even in an up market, you just got to be a little bit more selective. What I'm not seeing is huge appreciation in the markets that I'm working in, for the investment properties. You get into some of the bigger cities like Atlanta, you get Seattle, San Francisco, Dallas, Fort Worth, Houston, and that, you're watching prices go up a little bit more because there's more demand
Sure.
for the primary stuff, which is forcing the prices up. And some of the Midwest and Southern markets, you're just not seeing quite that. They've always been fairly stable. They'll see slight appreciation. So I still think that there's a lot of opportunity out there for folks. I feel that there's going to probably be somewhat of a market correction on pricing here pretty quick. I mean, I'm seeing some crazy stuff going on here in the Seattle market where, people are starting those bidding wars again on houses and paying over the sales price just to get a house. That's kind of insane.
We see that in Dallas too. Yeah.
Yeah. So I think that's going to be, interest rate rise. I think we're kind of at the top of where we're going to be at rates. We're probably at rates where they were 5-6 years ago. That'll go on for a while. Everybody will, they'll buy properties because right now it's a great market for selling your primaries. I mean, people are putting a for sale sign up. A couple hours later, it's sold.
Yeah, no doubt.
It's getting back to that. So the market itself, what it'll do is it'll create this people that need to refinance, and you'll watch rates go back down again. Then it'll start another refinance craze. And so we see that. So that's coming. Right now the refis are, they're really going down because, interest rates are higher right now. And so it's just kind of, it's just a normal cycle. And you can go back and you can look at, the cycles in the mortgage industry, and you'll see it just, waves. You're up one year, you're down the next, that sort of thing.
Yeah. I think, it depends on what everybody's goals are, but if you're getting into rentals, you should have at least a 5-year horizon, if not much longer than that, before you sell. So hopefully you can ride out some of those storms. It's right though. You're right though. A lot of the markets you work in, we work in. We have a, as we have a turnkey business where we help investors find properties in other markets and partner with operators there to have somebody rent them. And that's for those that are listening, it's called passiverental.com. We'll add a link down below. But a lot of the markets, a lot of the best markets that we found, or a lot of the best markets that you operate in, are the ones that don't have a lot of appreciation. They're the Memphises and the Midwestern cities, southern cities where there's not a lot of appreciation. But the good part of that is there's not a lot of downside either. It's more of get in and they're cash flowing now instead of get in and hope that in 10 years it appreciates.
Absolutely correct.
Yeah.
And I just, and I continue to follow the things with both Fannie and Freddie to see if there's any changes. I know at the very beginning you talked about some things that maybe you're aware of that they're trying to do, which is increase that number of finance property limit. Like I said, when I started in the industry in 1988, it was 10 finance properties, and 30 years later, it's still 10 finance properties. Whether that's going to change, that'll be wait to see. I've heard it for the last 5 years that they're going to increase it. It still hasn't happened. So we'll just wait and see what happens in that. And, it's going to be a challenge because, the mindset's always been with both Fannie and Freddie that once you get to this 10 or 6 that Freddie's got, they consider anything past that you're really a commercial borrower. You're really like a full-time real estate investor, and they're not business people. So it's going to be that change in that mindset that's going to force that. But, as they continue to look at the investment properties as far as how well they perform, they'll probably be a little bit more open to that. But time will tell. We'll all wait and see.
Yeah, absolutely. So talk a little bit, Steve, about what folks do if they're building. What we kind of advocate, and I know I believe you do too, is try to use the Fannie and Freddie type money for your first 10 rentals if you can. Because you're getting the best rates and you're getting it locked in for a long time. After people are beyond 10 finance properties, what do you advise? Where do they go from there?
Well, we've actually, I've partnered with a gentleman back on the East Coast that he's got some really good long-term rental programs.
Okay.
And so they can do 30 years with a 5-year, 7-year, 10-year balloon on them. So that's pretty standard. That's what you're going to see. The rates are going to be higher. And, with that type of product, they really look at the criteria is a little bit different in that they really, really look at debt service. There's a property debt service. So that's their number one criteria. And then they're going to look at as far as liquidation, as far as being number 2. And then they're going to look at the borrower last. So it's a little bit different, whereas we flip that around, with our side. And so, that's important. worked out an agreement where I can just refer people over to this guy and then he can take care of them. You know, I'll help compile some of the documentation for the client, get it sent over and that so that they can look at that. I think that's an option, you know, for folks once they get to those 10. The other thing too is, you know, if they're partners, you know, if they got to, you know, if they're married, the domestic partner, let's explore those options too. See if maybe we can turn that 10 into 20.
Yeah, I've heard you say that before. What makes that difference? So whether if you're married, that you could have 10 each instead of 10 combined. And I know I've heard you say that in the past where you're like, let's see if we can. What's that determining factor?
Well, you know, basically what it is, you don't have to be married. I mean, you could be boyfriend and girlfriend, you could be domestic partner.
Okay, sure.
You just have to have the ability to qualify individually. And when I say that, when I talk about the qualification, you've got to be able to first cover any existing housing expense, and then cover any installment or revolving debt that you have. So that's just it. Now, in some cases, people they're good at it. So maybe the one spouse makes more than the other. So the one spouse takes out the financing on the primary. And so that's good. So now all of a sudden the other spouse doesn't have that debt, doesn't have to worry about that. And that's a change that Fannie made this year, was that, you know, it used to be that if you were on the mortgage or if you were on title, they counted that as an obligated debt. Well, now they've dropped the on title thing. So you can still be on title. States they don't consider that an obligated debt anymore. So that was always a kind of a stopping point for some of this stuff.
Okay. So your primary residence counts as one.
Right.
If you have it financed, right? And then most do, obviously.
And they're only looking at financed properties. Now, and let me define financed property. You know, I get people that come back and say, well, they're only looking for stuff that's financed with either Fannie or Freddie. And I said, that's not true. You know, they'll look at commercial financing, they'll look at private financing, that's financed with private, you know, Fannie and Freddie. I mean, if it's on your tax returns and it's got financing, they're going to count it as a financed property, regardless of what the source is of the financing.
Okay. Well, if folks, maybe tell us where folks can learn more about you. And I want to say that for folks that are listening, I've known Steve for years. He's helped create this is the third time he's been on the show, actually 425 episodes, and he's created some content for us. We do some turnkey, we help sell some what we call turnkey rental properties in other markets that are great rental markets around the country. And we send people to Steve. So we've got a lot of experience working with Steve. He's a great guy. If you're looking to, we believe that owning rental properties is an awesome opportunity to build long-term wealth and kind of cement your retirement or start paving the way for that for sure. And if you need financing and if you don't have a lot of financed properties yet, then government-backed financing is the way to go, because there'll be a point where you outgrow that and you won't have the opportunity to do it. So your opportunity to do that really is early on. So with that said, Steve, if folks wanted to reach out to you and learn more about you, where do they go?
You know, they can go to they can send me an email. So my email address is steve.bighaus. You spell the last name Bighaus @spmc.com. Or they can just give me a call on my cell phone at 206-930-1801. Actually, I find that the clients calling me on the cell kind of get to know each other as far as, you know, what they want to do, kind of answer a lot of the questions that they might have, whether they're, you know, entry level, they're seasoned investors, as far as what our services can offer. I find those phone calls and that absolutely invaluable.
That's awesome. Hey, say the number one more time, Steve.
It's area code 206-930-1801.
Okay, and we'll add this email address and phone number down in the show notes here if anybody didn't catch that, if you're driving, if you're listening to this and driving. But just tell, I don't get anything for this, but just tell Steve you heard him on you heard us talking on Flip Nerd here, and he'll take good care of you. So Steve, appreciate you joining us today, my friend.
Thank you, Mike.
Always great to see you, and I'm sure we'll see you again. And by the way, Steve's also a member of our Mastermind Investor Fuel, which is just a really talented group of real estate investors and entrepreneurs. And so, Steve, any thoughts on being part of the Investor Fuel group? You want to? Can I ask you to give us a little plug about maybe what you get out of it and what you like about it?
Well, you know, I guess for my part is just obviously just the synergy, being around a bunch of different people within the industry. It's pretty amazing some of the things that people do. Yeah, listeners, and you know, you always learn. You can always pick up bits and pieces. Somebody's got something they're doing that's unique to them that makes them different. I look at ways of how I can incorporate that into my business, And then, of course, I'm always looking for opportunities as far as other markets and other lending opportunities.
Yeah. Yeah. Awesome. Awesome. Well, Steve, thanks again for joining us today. Definitely appreciate you. Appreciate your time today.
Okay. Thanks, Mike. Take care.
Yeah. Yeah. Hey, everybody. This is episode number 425 with Steve Bighaus. Some great little nuggets here if you're looking to finance your rental properties, especially if you're just getting started or you have less than 10. There's a great opportunity if you qualify to get some government-backed financing, which I'm not we won't get into politics here. The government maybe they shouldn't be involved in things like this, but when they are, they tend to subsidize it, which kind of works out in your favor usually. Correct. But appreciate all of you guys for listening. Again, this is episode number 425. If you haven't yet, please go out to Stitcher Radio, Google Play, wherever you listen to us at, iTunes, even YouTube, and subscribe and give us a positive rating. We appreciate your feedback. That's the fuel that keeps me cranking out these episodes week after week. So appreciate you guys. We'll see you on the next one.
Thank you, Mike.
If you're an active real estate investor already doing deals and looking to double or triple your business, you should consider joining the Investor Fuel Real Estate Investor Mastermind. We're a small group of investors that share our best practices, tips, and tricks with one another in an effort to all win. Real estate investing can be a lonely business for successful real estate investors, but it doesn't have to be. Investor Fuel members meet 4 times a year, but we talk to each other 365 days a year, and we focus on improving the profitability of our businesses, improving the quality of our lives. That's why we do this, right? And making an impact on those around us so we can truly leave a legacy. We limit our membership to only 1 to 2 members per market, so everyone shares their knowledge, tips, and tricks openly and honestly. Our members include some buying 1 to 2 houses a month, up to some of the most respected investors and leaders in the real estate investing industry, some of which have personally done over 1,000 deals. If you'd like to be considered for our invitation-only world-class mastermind, please visit investorfuel.com to request your personal invitation. Our next meeting is coming up quickly. Go to investorfuel.com now to learn more. Thanks for joining us for this episode of the FlipNerd.com Investing Show. If you're not yet an elite member of FlipNerd, you're missing out. We have tons of great training, including a new detailed masterclass published each month and live training webinars with experts twice a month. Plus, you'll get access to all of our archives, where we already have a growing library of masterclasses and other training videos. Elite members also get membership in our incredible online Mastermind group, where many of the top real estate investors from across the country, including many of the hundreds of guests I've had on the show in the past, are already members. Whether you're brand new, looking to get started, or a veteran, you simply must join today. I promise you won't be disappointed. To learn more or join today, please visit flipnerd.com/lab. That's flipnerd.com/lab. See you on the next show.